Hi, everyone. I've been getting a lot of requests to look into how to invest during a recession, so I've decided to start a series where I analyze various aspects of recession investing. The most frequently asked question to me by my friends and family is, what do I buy during a recession? So today, in the first part of the series, I'm going to attempt to answer that question by breaking it down into two key components. One, how have markets historically performed during a recession? And two, which sectors and asset classes have consistently done well during prior recessions? Hopefully by the end of this video, you'll have a better understanding of how recessions have affected markets in the past. I'm not giving financial advice, but I am going to examine historical market performances to make inferences about the future. As the old adage goes, history doesn't always repeat itself, but it rhymes. Before we get started, comment below what you think beat the last 6 recessions since 1980 before I reveal it towards the end of the video. And don't forget to hit that subscribe button and notification bell, and like this video if you've learned something new about recessions. So first, we have to assume that there is a recession on the horizon for this discussion to even be relevant. Now, forecasting recessions is not the focus of this video, but I have done a few interviews in the past 2 weeks examining whether or not a recession in the US is imminent. Here's what economist Alfonso Picatiello, founder of the Macro Compass, had to say. When are we getting a recession? That's my first question. Everyone wants to know.
Late summer 2023. Yeah, I didn't say 2024. I said 2023, which means my base case is in 3 to 4 months, the US is going to be in a recession. A recession, David, is loss in the job market. So people getting unemployed, higher unemployment rate, and a decline in earnings. And my models are pointing to a recession starting in about 3 to 4 months from today.
You can watch the full interview in the video link in the description box down below. Next, let's take a look at how frequently recessions have hit the US economy and how severe they've been. The textbook definition of a recession is 2 consecutive quarters of negative real GDP growth, but not all recessions have followed this definition, as I'm about to show you. I know there's been some confusion regarding its definition in the past year.
But I am optimistic because we continue to grow and at a rational pace. We are not anywhere near a recession right now in terms of the growth, but I think we can have what most economists call a soft landing.
But keep in mind that recessions are officially designated by the NBER, or the National Bureau of Economic Research, a nonprofit research organization in the US. And even though we did technically get 2 consecutive quarters of negative GDP growth, the NBER hasn't officially declared that a recession has hit us yet, because they look at a combination of other economic factors along with GDP growth, employment, consumption, retail sales, and personal income, among other things. I'll explain in another video, most of these indicators, and in particular employment, have held up quite well throughout 2022, despite a downturn in the financial markets, but conditions are starting to deteriorate. Looking back into the late 1940s, we see that the NBER has designated 12 recessions: 1948, 1953, 1957, 1960, 1969, 1973, 1980, 1981, 1990, 2001, 2008, and 2020. This table summarizes the start and end dates of each recession, how much real GDP was lost during the course of each of these recessions, as well as their duration. The worst recession in terms of real GDP lost was actually the most recent one in 2020, following the outbreak of the pandemic, with 8.5% of real GDP lost between February and April 2020. The mildest recession, by comparison, was 1969 to 1970, with hardly any change in real GDP during this time at all. The shortest recession, which is coincidentally also the worst on record, lasted 3 months in 2020. Note that the NBER didn't wait until 2 quarters of GDP contraction before designating this 1 quarter as a recession. The longest was in 2008, lasting 18 months between December 2007 to June 2009. The average duration of the past 12 recessions was 10.3 months, with recessions happening on average every 6.25 years. So the first question is, how have stock markets performed during the past recessions? For this exercise, we're going to use the S&P 500, which is a good proxy for the US stock market overall, as it encompasses about 70% to 80% of the total US stock market capitalization. Now, it's important to note that the S&P 500 has become more tech-heavy in recent years, with about 28% of the index comprised of big tech companies. This was not the case several decades ago, so the index performance performance back then may not be a perfect reflection of today's performance. This table summarizes the percentage changes during the past recessions, with the worst recession for stocks being 2008. The S&P 500 lost 38% during this time, and the recession with the best relative performance was in 1953, with the S&P 500 gaining 17%. Now, you're probably thinking, wait a minute, David, the S&P 500 dropped more than just 38% in 2008. Well, yes, it did, but I'm not measuring the peak to trough index levels. I'm measuring the percentage change from the start of the recession to the end, as designated by the NBER. Not before, not after. Now, on average, the S&P lost 7% over the last 12 recessions. The first thing you'll notice is that not all recessions have coincided with bear markets. In fact, out of the last 12 recessions, 5 of them saw stock markets rising for different reasons. Therefore, the assumption that bear markets happen in every recession is absolutely false, and so we can't predict with certainty that a market crash will happen during the next recession. Also, in the spirit of sharing, I've linked the Excel spreadsheet in the description below, so you can check my work and see how I've done the calculations if you're interested. Now, this leads us to question number 2. Which sectors have done well during past recessions? Not counting real estate, there are 10 sectors in the S&P 500: information technology, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, energy, utilities, and materials. For this exercise, we're going to use ETFs that track the sectors of the S&P 500 as a proxy, and we're going to go back only 2 recessions to 2008 because that's all the data that these ETFs have for all 10 sectors. We're also going to ignore real estate, as that was only added as the 11th sector of the S&P 500 in 2015. Now, intuitively, you'd think defensive sectors would do well. Things such as consumer staples and utilities. Basically, things that everyone needs at all times, independent of the economic conditions. Think things like electricity consumption, toiletries, groceries, things that have a very low price elasticity of demand. Does the data back up this theory? Yes. This table shows the performance of all the S&P 500 sectors in the last 2 recessions, and the sector with the best relative performance was consumer staples, with the XLP Consumer Staples Spider Fund ETF down only 15% on average between 2008 and 2020. The worst sector? Financials. Bank stocks got wrecked during 2008, and the XLF ETF dropped 57%, and 2020 was not much better. On average, financial stocks dropped 46% over the last 2 recessions using the XLF as a proxy. So that got me thinking, what are the top stocks within the consumer staples sector, and how have they done? Wouldn't the most recognizable names get the most business during a recession? Well, the largest 5 names in consumer staples ranked by market cap are Walmart, Procter & Gamble, Coca-Cola, Pepsi, and Costco. I looked into the largest one, Walmart, and what did I find? Since becoming a public company in October 1970, Walmart survived 7 recessions and beat 6 of them. The only recession that didn't see its share price rise was the first one, 1973 to 1975. This means that since the 1980s, Walmart shares gained every time a recession hit. On average, Walmart gained 17% over the last 7 recessions, and 26% if we count only the recession since 1980. I haven't had time to do this analysis for all the other consumer staple stocks, but I wouldn't be surprised to find similar patterns. If you know of another stock that has beaten every single recession since the 1980s, comment below and let us know. So what about gold, which has historically been seen as a safe haven asset? If something is considered a safe haven, then shouldn't it go up when stocks go down during a recession? First of all, as we've established, stocks don't always go down during a recession, so we have to be careful with the first assumption. Second, let's take a closer look at gold's actual correlation with the stock market. This chart shows the SPY ETF, aka the SPDR, as a proxy for the S&P 500 graphed alongside the GLD ETF, a proxy for gold, over the last 20 years or so, going back to 2004. The relationship is inconsistent, with gold falling alongside equities in 2008 and 2020, moving in opposite directions between 2009 and 2015, before moving up together between 2018 to 2020. The correlation coefficient since 2004 is 65%, with an R-squared of only 42%. This shows that gold is more of a diversifier to stocks than a hedge, with the difference being that a diversifier moves in more or less an uncorrelated fashion to a benchmark, while a hedge typically moves in the opposite direction. What happens to gold then during a recession? Let's apply the same time frame to gold as we did with Walmart. In the last 6 recessions since 1980, gold has gained every single time during the course of the recession, with an average performance of 10.6%. Now, it's important to note that during big market crashes such as 2008 and 2020, gold moves down with stocks initially as asset correlations tend to move towards 1 during big crashes as everything panic sells together. Gold is able to gain by the end of the recessionary periods because it has historically recovered faster than stocks. Finally, what about tech stocks? I've been asked how tech stocks perform during a recession as well, and the first thing to consider is that tech stocks tend to have a higher beta to the underlying index, meaning that they're more sensitive, generally speaking, to broad market swings in either direction. Let's take a look at how the Nasdaq Composite has done since 1971. The performance has roughly mirrored the S&P 500's, with the average return in the last 7 recessions since 1973 equaling negative 14% versus the S&P's negative 12%. It's also important to note that a lot of the companies in the S&P overlap with the Nasdaq Composites, which partly explains their similar performance. So there you have it. Consumer staples have been the best sector in the stock market during the past 2 recessions, with Walmart returning positive gains in every one of the last 6 recessions since 1980, while gold has also done quite well if held throughout the entirety of the recessionary period. Let me know if you have any other topics you'd like me to deep dive into, and stay tuned for next week's episode where I examine how the economy changes during a recession. As always, thanks for watching, and don't forget to subscribe.